Hey there, traders. Welcome back to TQFM Trading Strategies, where we dive into the best tips and techniques to help you succeed in the markets. If you're new here, make sure to hit that subscribe button and ring the bell so you never miss an update. Today, we have an exciting video lined up for you. We'll be reviewing a new trading strategy that combines two powerful indicators, the Bollinger Bands and the MACD. We'll cover how this strategy works, its advantages, and some potential drawbacks. So, if you're looking to sharpen your trading skills and gain an edge, stay tuned. Explanation of Bollinger Bands. Alright, let's start with the Bollinger Bands. Bollinger Bands are a popular technical analysis tool created by John Bollinger. They consist of three lines, a middle band, which is a simple moving average, and two outer bands that are standard deviations away from the middle band. The bands expand and contract based on market volatility. When the market is more volatile, the bands widen. When the market is less volatile, the bands narrow. Traders use Bollinger Bands to identify overbought and oversold conditions, as well as potential trend reversals. For example, when the price touches the upper band, it might be overbought, and when it touches the lower band, it might be oversold. Next, we have the MACD, or Moving Average Convergence Divergence. The MACD is a trend-following momentum indicator that shows the relationship between two moving averages of a security's price. It consists of the MACD line, the signal line, and the histogram. The MACD line is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. The signal line is a 9-period EMA of the MACD line, which acts as a trigger for buy and sell signals. The histogram represents the difference between the MACD line and the signal line. Traders look for crossovers between the MACD line and the signal line to generate buy or sell signals. A bullish crossover occurs when the MACD line crosses above the signal line, and a bearish crossover happens when it crosses below. Now that we know what Bollinger Bands and MACD are, let's talk about how to combine them into a powerful trading strategy. The idea behind this strategy is to use Bollinger Bands to identify potential entry and exit points, while the MACD helps to confirm the trend direction and momentum. Here's how it works. First, we look for the price to touch or move beyond the Bollinger Bands. This gives us an indication that the price might be overbought or oversold. For instance, if the price touches the lower Bollinger Band, it might be a sign that the asset is oversold and could be due for a rebound. Next, we use the MACD to confirm this potential reversal. Specifically, we look for a bullish crossover, where the MACD line crosses above the signal line to confirm a buy signal. On the flip side, if the price touches the upper Bollinger Band, it could indicate that the asset is overbought. In this case, we look for a bearish crossover on the MACD, where the MACD line crosses below the signal line to confirm a sell signal. Let's go through a couple of examples. Now, let's discuss some of the advantages of using the Bollinger Bands and MACD strategy. 1. Improved signal accuracy. Combining two indicators helps filter out false signals. Bollinger Bands identify overbought and oversold conditions, while MACD confirms the trend direction, making for more reliable trading signals. 2. Versatility. This strategy can be applied in various market conditions, whether it's a trending market or a ranging one. The combination of indicators helps adapt to different trading environments. 3. Clear entry and exit points. The strategy provides clear and straightforward entry and exit points. When the price touches the Bollinger Bands and the MACD confirms the signal, it makes it easier for traders to make decisions without second-guessing. While this strategy has its advantages, it's also important to be aware of some potential drawbacks. 1. Lagging indicators. Both Bollinger Bands and MACD are lagging indicators, meaning they rely on past price data. This can result in delayed signals, potentially missing the optimal entry or exit points. 2. False signals. Despite combining two indicators, there is still the potential for false signals, especially during periods of high volatility or market consolidation. This can lead to entering or exiting trades prematurely. 3. Complexity for beginners. Interpreting the combined signals from Bollinger Bands and MACD can be challenging for new traders. It requires a good understanding of both indicators and how they work together, which might be overwhelming for beginners. 4. Requires constant monitoring. To make the most out of this strategy, you need to constantly monitor the charts and be ready to act on the signals. This can be time-consuming, especially for traders who can't dedicate a lot of time to watching the markets. To sum up, the Bollinger Bands and MACD strategy can be a powerful tool in your trading arsenal. By combining these two indicators, you can potentially improve your signal accuracy and make more informed trading decisions. However, remember that no strategy is foolproof, and it's essential to understand the potential drawbacks, such as lagging indicators and false signals. Please keep in mind that trading involves risk, and it's crucial to do your own research and practice with paper trading before committing real capital. This video is for educational purposes only and is not financial advice. If you found this video helpful, don't forget to give it a thumbs up and subscribe to TQFM Trading Strategies for more insights and tips on trading. Hit the notification bell so you never miss an update. We'd love to hear your thoughts and experiences with this strategy, so leave a comment below. And if you have any questions or topics you'd like us to cover in future videos, let us know. Thanks for watching, and happy trading!